Hello everyone, my name is Rezky Aswar. I'm from Management 25B. Today, I'm going to talk about financial reports. A financial report is basically a communication tool between a company and its owners or other parties. It's used to show accountability and transparency, or in simple words, to explain how the company's money is being managed. Usually, a financial report is prepared once a month. There are several types of financial reports, such as the statement of comprehensive income, the statement of change in equity, and the statement of financial position. Each of these reports plays an important role in helping people understand the company's financial condition. Now, let's move on to the statement of comprehensive income. This report is basically a summary of a company's operation during a certain period of time. It includes two main components: income and expense. Income shows how much money the company earned, while expense show how much money is spent during that period. When the result of income minus expense is positive, that means the company makes a profit. But if the result is negative, it means the company has a loss. So this report helps us understand whether the company is doing well or facing financial problems. Next, we have the types of income statements. There are two main types: single step and multiple step. In a single step income statement, business and non-business revenues and expenses are not separate. Meanwhile, in a multiple-step income statement, those revenues and expenses are clearly separate. For a retail company, the income statement usually includes sales revenue as the main source of income. On the expense side, it includes selling expense, administrative expense, and the cost of goods sold, or what we call HPP. This kind of report help show more detailed information about where the company's profit or loss comes from. Now let's talk about the capital statement, or in Indonesian, Laporan Perubahan Modal. This report is a summary of change in the owner's equity during a specific period of time. It usually includes several components: the beginning capital, owner's withdrawals, net income or loss, and ending capital. Here's the key idea: if the company earns a profit, it increases the owner's capital. If the company has a loss, it reduces the capital. And when the owner makes personal withdrawals, that also reduces the capital. So, this statement helps us see how the owner's equity changes over time. Next, we have the balance sheet, or in Indonesia, Laporan Neraca. A balance sheet is a list of all assets, liabilities, and owner's equity of a company at a specific date. In simple terms, it shows what the company owns and what it owes. The balance sheet has two main parts: assets and liabilities with owner equity. Assets are the resources owned by the company, such as cash, equipment, or building, while liability and owner's equity represent the company's obligation and the owner right to the asset. So the balance sheet gives a clearer picture of the company's financial position at a certain point in time. Finally, let's talk about the basic principle of the balance sheet. The key concept here is simple. Assets equal liabilities plus owner's equity. In other words, everything the company owns must be equal to everything it owes and the owner's capital. Assets represent the company's property or research. Meanwhile, liabilities are the company's debts and owner equity is the owner's investment in the business. So, the balance sheet must always stay balanced. That's why it's called a balance sheet. Alright, that's all for my presentation about financial reports. From what we learned, financial reports play an important role in showing how a company manages and explains its financial activities. I hope my explanation helped you understand more about the types and function of each report. Thank you for listening and I really appreciate your attention. Have a great day.